Hi, my name is Cooper, and my group will be talking about whether active funds actually underperform passively managed funds. Now, in the article, Are Passive Funds Really Superior Investments? He talks about five ETFs that continuously outperform actively managed funds. Now, my group consists of Raquel, Jacob, Jared, myself, and Ryan. This presentation we broke into five parts: the investment issue, the author's approach, the findings, implications, and critiques and improvements. And by the end of this, you'll be able to find out how you can implement this ETF strategy into your own portfolio. The investment issue is traditional research shows actively managed funds underperform passive benchmarks after expenses. This being something as simple as the S&P 500. And after expenses, it actually some active funds underperform that. However, most studies rely on non-investable models like Pharma French, the three-factor model, and a Carhart four-factor model, which are both very complex math equations that are purely theoretical alpha in generating alpha. This creates a gap between theoretical performance and real-world investor outcomes. This article reevaluates the debate using tradable ETFs to test if passive portfolios truly outperform active funds once realistic costs and constraints are included. The background and motives of the study is because dozens of studies have showed that after expenses, actively managed funds consistently underperform benchmarks. These findings have shifted investors' assets towards passive funds, which rose from 16.4% to 26% of assets under management in just 5 years. However, prior methodologies rely on unrealistic, non-investable benchmarks and exaggerating passive advantages. The exaggerations of passive advantages would be something like the low cost of fees or the growth in the market. The author aims to bridge theory and real-world investing by testing a small, replicable set of ETFs to match or beat actively managed funds in future periods. Why this matters is because billions in investing capital have shifted from active to passive management. And this is purely because of the high fees that are included with actively managed funds. Most research supporting active superiority uses unrealistic benchmarks that can't be replicated. Like I said before, those complex math equations that are theoretically generating alpha. The author argues investors need results based on real-world tradable strategies, not just abstract indexes. The real-world tradable strategies that are used here in this article are 5 ETFs that pretty much track different parts of the market. Implications extend to fund selection, advisory, recommendations, and market efficiency. The market being efficient means that all the information that is out there reflects the market's price. So it is very hard to beat that benchmark. What prior studies missed? Previous models ignored transaction costs, short sale limits, and ETF expense ratio. Some of these actively managed funds are massively short selling things, and it's very hard for a regular investor to copy those strategies. And as I said before, actively managed fund transaction costs are way more expensive than something as simple as an ETF. No study had tested whether a small, realistic ETF portfolio could match active funds' risk and beat them in returns. So the risk was managed with the actively managed funds risk was compared with the ETF portfolio's risk of the past period to later on predict future returns. This study directly addresses the gap with 15 years of data and 886 actively managed funds. Of those 886 actively managed funds, the passive strategy actually outperformed 77% of those funds, 78% if you aren't including short selling. Core principles behind the active and passive debate. The central tension in investing is between market efficiency and manager skill. The manager skill being how well can he generate alpha. Passive investing assumes markets are efficient and that the price already reflects all information, making outperformance unlikely after costs. Active management argues that skills, research, and timing can uncover mispriced assets and generate alpha. The author talks about understanding whether active skills add value once fees and constraints are included is key to the modern investing dilemma. This being because of the high fees in actively managed funds and the low fees from passively managed funds, where passively managed funds, this set of passively managed funds, the 5 ETFs, actually outperformed the market benchmark. Now I'll be passing to our next speaker, Jared, to take us further.
Hey guys, I'm Jared, and I'm going to be discussing the author's approach, specifically their methodology, ETF selection process, clustering, regression, risk matching, and portfolio construction. To start off with, I'm going to be talking about the author's goals and the limitations of current methods. The authors Edwin J. Elton, Martin J. Gruber, and Andre de Souza developed a 5 ETF model to evaluate active mutual funds. The problem they were facing is that traditional benchmarks like Fama French and Carhart are not truly investable strategies. This makes evaluating active fund performance against a truly passive alternative difficult. The solution to this was to create a small investable set of exchange-traded funds, ETFs, that effectively captures the risk of the broad United States equity market. Here we have their ETF selection. This slide focuses on the multi-step process for selecting the 5 representative indexes and turning them into an investable portfolio. The initial sample started with 69 broad United States equity indexes, or ETFs. After filtering out non-relevant categories like bonds, international, etc., and then their core methodology focused on market adjustment and cluster analysis. For market adjustment, returns were adjusted to isolate factors beyond the general market. Ward's cluster analysis was performed on market adjusted returns to group similar indexes. During the selection process, the clustering reduced the set to 11 representative indexes, accounting for 79% of the variance. Fama French testing framework confirmed that only 4 of these were necessary and sufficient to price the full set. The final parsimonious set consisted of 5 indexes when the market index was reintroduced. For the investable benchmark, the 5 indexes were replaced by the lowest cost ETFs tracking them. So this is the investable passive strategy. Here we have portfolio construction. This slide details how passive ETF portfolio was constructed to match the risk of each active fund. The goal was for each of the 883 active funds to build a risk-matching portfolio using the returns of the 5 base ETFs. During the fit period, portfolio weights were determined using 2 years of previous monthly data. The method they practiced was to use constrained linear regression of the active fund's return on the 5 base ETF returns. The constraint of the portfolio weights strictly must sum to 1. The regression minimized the unexplained error. The 2 scenarios examined were with short sales allowed and no short sales allowed. With short sales allowed, they had unconstrained weights, which is the academic standard, and no short sales allowed had weights constrained to be non-negative, making them implementable for most investors. In forming a matching portfolio, 2 cases were looked at. The first case follows the type of model where all ETFs are allowed to be sold short in unlimited quantities. In the top right, this is the model typically used in return-based asset allocation studies. This is the mathematical formulation for constrained linear regression used to determine the portfolio weights. Here we have performance assessment and key findings, which covers the testing phase and the surprising results from comparing the ETF portfolio to the active funds. For evaluation, the performance of the constructed ETF portfolio based on weights from the fit period was compared to the active return of its corresponding active fund in the subsequent 1-year period, the forecast period. The key finding was that the passive outperforms the active. The risk-matching ETF portfolios significantly outperformed the active funds in the following year. A few specific results were for unlimited short sales, which outperformed 77% of the time, with average excess return of 1.44% per year. For no short sales, they outperformed 78% of the time, with average excess return of 1.37% per year. Here we see the overall result and practical significance for investors and academics. The main conclusion is that a low-cost, truly investable passive strategy, the 5 ETF model, can be constructed to effectively match the risk of active funds, and it generally outperforms them on a forward-looking basis. With lower risk, the matching ETF portfolios also had a lower standard deviation of returns on average than the active funds they mimicked. Some key findings that the authors learned were that this strategy provides a valid investable benchmark for evaluating active fund competency. It also suggests that a large majority of United States equity active funds failed to outperform a low-cost, passive portfolio that simply replicates their risk exposure. This result holds true even under the practical constraint of no short sales. Thank you for listening. I will now hand it over to the next presenter.
Hello, my name is Jacob Burkemper, and I'm here talking about the key findings of our research. We're here talking about one of the biggest debates in finance, active versus passive investing. For years, academic research has claimed passive strategies are superior, often citing the outperformance of complex factor models over active funds. But in the research paper, Are Passive Funds Really Superior Investments?, they asked a more practical question. Can the average investor actually go out and buy those superior strategies? Their key finding is that the superiority of passive investing is absolutely real, but it's rooted in cost efficiency rather than theoretical factors. So this is our key finding number 1. Academic factors are not often replicable. This debunks a common practice. Many studies will construct a theoretical benchmark based on various risk factors, like small cap value or momentum. Fama-French factors use those and show that the theoretical factor outperformed the average active manager. The problem with that is that these factors often do not exist as real tradable investment products. They're constructed using historical data, and the methods used to track them are often not replicable by an ordinary low-cost ETF. An investor cannot simply buy a theoretical factor. So the high performance cited in many research papers are pretty much unobtainable in the real world. This moves us on to our second key finding. Risk replication requires a minimal set of ETFs. This is one of the more practical discoveries, and it shows that you don't need dozens of funds to have adequate diversification. They demonstrated the complex risks present across the entire spectrum of indexes, and actively managed mutual funds can be captured and replicated with a minimal set of just 5 core exchange-traded funds, or ETFs. These 5 ETFs, covering exposures like large cap value, large cap growth, small cap growth, mid cap value, and the overall market, were shown to be sufficient. This finding dramatically simplifies portfolio construction, and it means that the everyday investor doesn't need to chase asset classes or complex strategies, and they can achieve adequate diversification and risk exposure using a small set of ETFs. This moves us on to our third finding. Risk-matched passive portfolios outperform active funds. So once they had the simple, highly efficient, risk-replicating ETF basket, they put it to the test. They created passive portfolios that were risk-matched to hundreds of actively managed mutual funds. This was a direct comparison of performance, and their results were conclusive. The risk-matched passive ETF portfolios consistently delivered higher net returns than the active funds, and it confirms what many people had suspected, that the high fees, transaction costs, and operational costs of active management were the main destroyers of the benefit derived from them. The analysis validates the value of passive management based on real results. This moves us on to our fourth key finding. Expense ratios are the dominant factor. This is a key finding, and it focuses on fund selection. They asked if you decided to go passive and you have 5 ETFs all tracking the S&P 500, which one should you choose? And the finding was decisive. The single most important factor determining superior performance is the expense ratio. They found that minor differences in a fund's tracking error or small variances in management technique were overshadowed by the cost. So an investor's most powerful decision is simply choosing the fund with the lowest overall fee. And this provides a quantifiable, predictable advantage, and it outweighs marginal improvements that active funds could provide. This moves us on to our final key finding. Superiority lies in cost-effective trading. Finally, their research emphasized the practical superiority of the passive vehicle itself, particularly the ETF structure. The ETFs offer extremely low expense ratios, and they also use in-kind creation and redemption mechanisms. The outcome is crucial because it means ETFs are generally more tax efficient, which minimizes the capital gains distributions you receive as an investor each year. So in summary, the superiority of passive investing isn't a complex concept. It's a mathematical advantage. If you keep your portfolio simple and you keep your diversification to the core risk factors and be ruthless about finding the lowest costs, you will find the superior investment. Thank you.
Hi, my name is Raquel, and I'll be going over section 4. Now that we've looked at the trends for passive investing, I want to just quickly define what we mean by active versus passive. So for active investing, we're talking about when a fund manager is trying to pick the best stocks to ideally beat the market. So it's like trying to kind of win by maximizing the profits you can make. Whereas passive investing is more, you're going along with the market and just kind of trying to not necessarily break even, but do well without maximizing profit. You're just trying to do consistently well. So with that in mind, let's talk about the implications of this finding and the practical applications to the real world. We're going to talk about the implications for investors, for funds and fund managers, and the market overall. So first, the implications for investors. Passive investing makes it a lot easier to get strong returns without needing to have a finance background or degree. And the study that we looked at for our project talked about how you can match or beat professional fund managers by holding a mix of 4 to 5 ETFs. That's accounting for flexibility. Cost efficiency wise, it's just cheaper because ETFs and passive funds have lower fees. And if you're not needing to pay a fund manager to help you set them up, that's a plus as well. Over time, those lower costs add up and can make a big difference in the overall returns. And they're more transparent in nature as well, so there's less surprise and less volatility for the most part. The market trend will show that passive funds now hold over 50% of US mutual fund assets. So it seems like it's already starting to kind of grow in popularity. And the takeaway is that investors will be more empowered. So they'll be able to build a solid, more diversified portfolio without having to rely on expensive management for that portfolio. Our next implications is for funds and fund managers. So those fund managers will notice as we shift towards more passive investing that everyone is sort of looking for the same type of stock. So think the S&P 500. When we think EFTs, if people are investing in a fund like that, it tends to have less volatility and be more easily predictable. So the need for fund managers would kind of decrease unless they have a specialty or niche that they are helping people get into, like investing in tech or investing in medical or things of that nature. So that would be a strategic shift, which would be sort of factor-based. They would need to be using sort of a different strategy to get people involved in investing in different stocks, like active stocks. In active ETFs, saw flows tripling in Europe. So for our real world example, it looks like in 2024 in Europe, active ETFs tripled in inflow to 19.1 billion pounds. So firms like Vanguard had to start reducing their fees for certain EFTs to be able to stay competitive, so people would come to them for investing. The takeaway here would be that fund managers need to be a little bit more innovative. They'll need to show their value and just overall show investors why it's worth it, because otherwise they'll just stick with lower cost passive funds anyway. Our third implication is for the market overall. So at the market level, passive investing changes how money will move. So when lots of investors are pouring cash into index funds, it can affect the prices more than the actual fundamentals of the actual companies. That could make markets look more correlated, so everything would kind of look like it's moving together, but it could also amplify like swings at times where the market's a little bit more volatile. So for the efficiency of the market, the passive investing can reduce price discovery over time. And for emerging trends, those active ETFs that are growing and blending would do well alongside passive investments. In 2024, passive equity funds in Europe attracted 247 billion pounds, while active ETFs started growing as well. And these structural changes make the market efficient in the short term, but it can reduce the long-term price discovery, so it's a little bit harder to gauge where those are at. So the takeaway is that the investors and regulators will need to keep an eye on the liquidity of market concentration and be vigilant for potential volatility risks. So our takeaways would be that the investors, using our theory, our findings about building with passive funds, can build diversified portfolios using 4 to 5 ETFs and keep fees lower to improve their long-term returns. For fund managers, the takeaway is the need to emphasize what sets them apart, like finding niche strategies or having a specialized expertise. And for markets, it would be that regulators and participants should watch for higher correlations and potential risks from lots of money going into the passive funds. I'm going to pass it to Ryan to close us out.
Hello, everybody. My name is Ryan Moran. I'm a part of the group Cashflow Capital, where we have been discussing whether or not passive investments are actually superior to actively managed mutual funds. And in this portion, we are going to be discussing some of the critiques, limitations, and future directions for this study. And specifically, I'd like to dive more into the data and model limitations, the practicality considerations, and how to improve or extend the research for this study. First, let's start off with the data limitations. And within the data limitations, the first one I'd like to discuss is survivorship and selection bias. And the issue here is that the mutual fund and ETF data sets likely include only funds surviving to meet specific standards. And this omits funds that are closed, merged, or liquidated, which are often poor performers. This results in upward bias in both active and passive samples, which overstates ETF success or underestimates active underperformance. An improvement for this would be to rebuild the sample and include dead or delisted ETFs and funds to avoid biased outperformance rates. Moving on, another data limitation I'd like to discuss is limited time horizon and the US only sample. Now first I'd like to dive into just the limited time horizon. And the issue here is that the study starts in 2003 and runs roughly 15 to 16 years, which is a period mostly dominated by a long US equity bull market, which is mostly post-global financial crisis, which happened in the year 2008. And this bull market mostly is advantaged towards the passive strategies. And an improvement for this would be to extend the data earlier, so pre-2003 time, and the latter, which would be the post-2019 through the current year, 2025. And this would include other financial crisis periods such as the dot-com crash, COVID-19, and the 2022-2023 rate hikes that we saw recently. And I feel like this would give a more accurate representation as to the actual comparability between the two. Moving on, I'd like to now discuss the U.S. only sample. And the issue here is that it is also important to mention that only U.S. equity mutual funds were studied inside of this study. And the results may not generalize to global equity, fixed income, or hybrid funds. And an improvement here would be to expand analysis to international and sector funds or mixed asset mutual funds using region-specific ETFs. And this can test universality of the small ETF spanning set approach. Moving on to the model limitations, the first one I'd like to discuss is arbitrary ETF selection. And the 5 chosen ETFs, which were selected from cluster analysis, may not represent the most efficient or stable basis set over a period of time. And an improvement here would be to use regularized model selection to let data choose the optimal ETF subset dynamically and to minimize overfitting. And these model selections techniques can include the lasso, the elastic net, and principal component regression. Moving on to the simplified constraints. The issue here is that the shorts allowed and no shorts allowed cases that were studied inside of this study are a little bit too far extreme simplifications. And real investors face capital allocation limits, liquidity needs, and regulatory constraints. And an improvement would be to actually add more realistic constraints such as weight caps, minimum liquidity thresholds, and turnover limits. And to dive more into these, we could place a max portfolio weight of 50% per ETF, which would yield a more diversified and investable ETF portfolio. For minimum liquidity thresholds, this would require each ETF used in the model meets a minimum trading volume and market capitalization levels, which ensures that the spanning set remains complementable by both retail and institutional investors. Lastly, turnover limits, they restrict how much the ETF portfolio weights can change from one year to the next. And by adding this realistic constraint, this smooths transitions and approximates realistic rebalancing behavior. Moving on to some of the practicality considerations, the first one I'd like to touch up on is the implementability and transaction costs. The issue here is that annual rebalancing seems easy, but real investors face bid-ask spreads, tax lots, and slippage, especially in the less liquid ETFs. And an improvement here would be to incorporate transaction cost modeling using the bid-ask data and simulate trade impact across different fund sizes, specifically the retail and institutional. And use cost curves that are proportional to the AUM turnover. Moving on to scalability. The issue with scalability is that the study implicitly assumes small scale trades. And if adopted by larger institutional investors, the capacity constraints could distort the ETF prices. And an improvement for this would be to run liquidity stress tests to simulate how ETF capacity, which can be found by multiplying the daily volume by the price by 5%, would ultimately limit strategy scaling without excessive market impact. And another important thing that I would like to touch up on this slide is the tax efficiency. ETFs are generally more tax efficient than mutual funds because they use in-kind redemptions, allowing them to avoid triggering most capital gains distributions. And a recommendation for this moving forward in future research, we should measure the after-tax alpha of ETF portfolios versus active mutual funds by incorporating historical capital gains distributions and realistic investor tax rates. This will ultimately show how much of ETF's advantage remains after accounting for the taxes. Moving on to how we can ultimately improve and extend the research for this study. The first one I'd like to talk about is the multiple period portfolio optimization. And ultimately this means instead of annual risk matching, we can use multi-period optimization considering expected returns, variances, and transaction costs. And we could find this using mean variance and Black-Litterman frameworks. Moving on to macro conditional models. Include macroeconomic indicators such as yield curve slope and volatility index to condition the ETF weight estimation, testing whether factors exposures vary with a different regime. We can also improve by international replication of this study to replicate the study with European, Asian, and emerging market ETFs in other sectors. And we could also improve or extend the research through investor utility framework. And this means to translate performance metrics, such as return and volatility differences, into utility gains for different risk aversions, showing practical relevance for both retail and institutional investors. To wrap us all up here, I'd like to discuss some of the key takeaways that us as a group were able to take away from this study. The first one I'd like to go over is that simple ETF portfolios can replicate and outperform most active US equity funds. We were also able to conclude, using only 5 ETFs from this study, the model beat active funds approximately 78% of the time. It also delivered an average excess return of approximately 1.4% per year. Results held with or without short sales ultimately showed ETFs showed lower volatility. Evidence also supports low-cost passive investing does outperform active management, and the model is simple, transparent, and it is easy to replicate for real investors like you and I. Thank you for listening. This has been the Cashflow Capital, discussing whether or not passive funds are actually superior investments to actively managed mutual funds.